Disclaimer. Something truly unprecedented just hit the silver market, and if you're not watching closely, you're about to miss what could become the biggest wealth transfer in precious metals history. On December 18, 2025, JP Morgan Chase placed a purchase order that should make every investor sit up straight. They acquired 12.4 million ounces of physical silver at $71.80 per ounce. No paper, promises, no derivatives, real metal. The same bank that spent the past 15 years pushing silver prices lower through naked short selling just paid up for actual bars. Let that sink in. JP Morgan doesn't make emotional spur-of-the-moment moves. They've been the house in this casino for decades, unloading paper IOUs while quietly building a physical position at suppressed prices. But something changed, something serious enough that they tossed their entire playbook in the trash. HSBC moved 2 days later, buying 18.3 million ounces at $72.15. Then Bank of America jumped in on December 23rd, locking down 16.7 million ounces at $72.40. According to the CFTC Commitment of Traders report released December 20th, these three institutions combined to secure 47.4 million ounces of physical silver in just 6 weeks. You need to grasp how extreme this reversal is. These aren't tiny speculative bets. We're talking 47.4 million ounces of real metal, enough to build roughly 1.3 million electric vehicles or produce about 950,000 solar panels. They're pulling inventory out of London vaults, paying extra for transport, tolerating delivery delays, and doing it all at prices 158% higher than where they were selling paper contracts only 8 months ago. Why? What do they know that forced this total strategic U-turn? The answer is sitting in plain sight at the COMEX warehouse in New York. As of December 24th, 2025, registered silver inventories stand at just 34.2 million ounces. Put that in context. In January 2021, COMEX held 110 million ounces of registered inventory. In 4 years, 69% of deliverable silver simply disappeared. And here's the part most people miss. Those 34.2 million ounces aren't just waiting around for whoever shows up, they're already spoken for. December delivery obligations alone total 89 million ounces across all contract, months coming due in the next 97 days. The February 2026 contract shows 67,000 open contracts, representing 335 million ounces of notional silver. Do the math with me. COMEX has 34.2 million ounces available. Delivery obligations exceed 89 million ounces just for contracts settling before March 31st. That's a 160% shortfall. This isn't a normal supply squeeze. This is a mathematical impossibility. COMEX runs on a fractional reserve model just like your bank. When you deposit $10,000, the bank doesn't keep all $10,000 in the vault. They keep maybe $1,000 and lend the rest, betting everyone won't demand their cash at the same time. COMEX does the exact same thing with silver. They issue contracts that claim far more metal than they truly have on hand, counting on most traders to take cash settlement instead of demanding physical delivery. For decades, that assumption held up. Less than 3% of futures contracts typically went to delivery. But what happens if that number jumps to 15% or 30%? What happens when the people holding those contracts aren't paper speculators trying to flip for a quick profit, but sovereign wealth funds, central banks, and industrial users who actually need the metal in their hands? You get exactly what we're seeing now, panic buying at any price. The London Bullion Market Association just released their Q4 2020 Go-To Vault report, and the figures confirm our worst fears. LBMA vault holdings fell by 127 million ounces between September and December 2025. That's the biggest quarterly outflow in the organization's 117-year history. Asian refiners are pulling metal out of London. Middle Eastern sovereign wealth funds are executing withdrawals that bypass traditional COMEX settlement. The physical silver that used to move freely between London and New York, the arbitrage mechanism that kept COMEX liquid, has been cut. For years, whenever COMEX got tight, they could simply draw silver from London vaults through exchange for physical transactions. London had deep inventory, and the machine kept running. But those EFP spreads that used to trade at 2 or 3 cents per ounce, the tiny premium to swap COMEX paper for London metal blew out to 1.47 per ounce in November 2025. That bridge is collapsing because there's no metal left to arbitrage. Think about what JP Morgan saw when they ran those numbers. They're not buying 12.4 million ounces because they suddenly fell in love with silver as an investment. They're buying because they have delivery obligations they can't meet through normal channels. They have clients, likely sovereign wealth funds or major industrial users, holding futures contracts with first notice dates approaching, and those clients are demanding physical delivery. If JP Morgan fails to deliver, the default penalties would dwarf the premium they're paying today. Worse, they risk reputational damage in the derivatives market, where credibility is worth billions. So they're doing what any trapped short seller does once they realize the game has changed. They're paying market prices and hoping they can cover before the real squeeze detonates. HSBC and Bank of America are in the same position. According to London Vault withdrawal records verified through LBMA's allocated gold and silver holdings report, these three banks pulled a combined 41 million ounces from London storage between November 15th and December 20th, 2020. They're not diversifying. They're not rebalancing. They're racing to secure physical metal to avoid defaults on contracts they never expected to deliver. And here's the nightmare: even after all that panic buying, even after locking up 47.4 million ounces in 6 weeks at premium prices, the math still doesn't clear. COMEX registered inventory sits at 34.2 million ounces. Add the 47.4 million these banks just acquired and you get 81.6 million ounces. But delivery obligations for just the next 3 months exceed 89 million ounces. They're still short. After spending over $3.4 billion in the most aggressive physical accumulation campaign in modern precious metals history, the big banks remain mathematically unable to meet their obligations. Which means only one of two things happens next: either they keep buying, driving prices even higher as they chase a shrinking pool of metal, or they default. There is no third option. Fractional reserve systems work perfectly until the moment delivery demands exceed available supply, and that moment is unfolding right now. The banks already know what's coming. That's why they're paying $72 per ounce for metal they were selling paper claims on at $28 just 8 months ago. They've seen the delivery calendar, they've run the numbers, and they've realized the COMEX system is cracking, so they're trying to get on the right side of history before the crowd catches on. So ask yourself one simple question. If JP Morgan is willing to pay around $70 per ounce today to avoid what's coming in 97 days, what do they think silver will be worth when the first defaults hit? And how did we get here? It traces back to 3 moves in the last 90 days that Wall Street hoped you'd never connect. First, on November 8th, China broke years of silence and disclosed its silver reserves, 23,000 metric tons, about 739 million ounces more than the world mines in a year. For 16 years, China reported zero. Analysts assumed they'd sold it all after the 2011 spike. Wrong. They were accumulating quietly, absorbing mine supply and telling nobody. That disclosure wasn't an accident, it was a warning shot. Then, 3 days later, China's Ministry of Commerce issued an emergency order banning all silver exports effective immediately. Not tariffs, not quotas, a full cutoff. If you're trying to source silver out of China, you can't. The metal stays inside their borders. China controls about 18% of global mine production, and now they're weaponizing silver the same way they weaponized rare earths in 2010. This isn't normal economic policy, it's resource warfare. And according to the U.S. Geological Survey's December 2025 Mineral Commodity Summary, China produced 3,600 metric tons of silver in 2024, about 115.7 million ounces that just vanished from the export market overnight. That supply now stays in Shanghai, Beijing, and Shenzhen, while foreign manufacturers scramble for alternatives that don't exist. Which raises the real question: why reveal reserves and ban exports unless you expect prices to rise hard? Because that's exactly what they're signaling. We have the metal, you don't, and we're not sharing. That's what a country says when it knows scarcity is coming and wants the world to notice it got positioned early. Industrial users caught on faster than the financial markets. On December 12, 2025, Tesla First Solar and 13 major solar manufacturers sent a joint warning to the U.S. Department of Energy. They weren't bluffing. Solar panels need silver for conductivity, about 0.55 ounces per panel. At $28 per ounce, silver was roughly 3% of panel costs. At $72, it jumps to 7.8%, crushing margins for utility-scale projects. But here's the tell: the same companies warning about halts are quietly locking in 3-year forward supply at $70 to $75 per ounce. Tesla secured 8.4 million ounces at about $71.20 on December 15th for delivery through 2028. First Solar locked 12.7 million ounces at around $73.50 on December 18th. Why complain in public but buy in private at the same prices? Because procurement teams believe 72 is the floor, not the ceiling, and they're terrified that in 6 months there may be no supply at any price. That's why the demand destruction story is a smokescreen. Real demand destruction means you stop buying. These companies are buying harder than ever just through forward contracts instead of spot, because securing metal at 72 beats hunting for non-existent supply at 150 next year. And the fundamentals back it up. According to the Silver Institute's December 2025 interim report, the market has rarely been tighter. Fabrication demand for 2025 hit 1.24 billion ounces, with solar up sharply, EV demand rising and electronics still massive. Meanwhile, mine output slipped to about 822 million ounces. Recycling added roughly 164 million. And when you stack supply against fabrication plus investment demand, the gap implies a deficit on the scale of hundreds of millions of ounces. That leaves a deficit of 265 million ounces in a single year, the biggest annual shortfall on record. And deficits like that only get filled one way, by draining existing inventories. The silver sitting in COMEX warehouses, LBMA vaults, and Shanghai exchange stockpiles. But those inventories are already shrinking fast. COMEX registered stocks have fallen from 110 million ounces to 34.2 million. LBMA holdings dropped 127 million ounces in Q4 alone. Shanghai reported deliverable inventory of only 47 million ounces as of December 20th. Add them up, and you get roughly 128.22 million ounces of registered deliverable silver across the world's major trading venues. That's against annual demand of about 1.58 billion ounces. That's only enough for about 29.6 days of global consumption. Less than 1 month. That's how close the shelves are to going empty. But the real stamp of inevitability didn't come from traders, it came from the most conservative institution on earth. On December 3, 2025, the Bank for International Settlements released its quarterly review, and a footnote buried deep inside changed the entire game. The BIS said central banks could classify silver as a Tier 1 asset alongside gold for reserve requirement calculations under Basel III. That reverses a stance that's existed since 1973, when silver was effectively stripped from central bank balance sheets. For more than 50 years, regulators treated silver like an industrial commodity. Now suddenly it's being treated like money again, and central banks are acting like it. Switzerland bought 187 tons in Q3. Singapore added 243 tons in October and November. Saudi Arabia reportedly purchased 460 tons between September and December, based on IMF data released December 15th. These aren't hedge funds chasing a trade. These are institutions that move slowly, think in decades, and buy only when they believe a long-term shift is underway. Saudi Arabia is the clearest signal. They're reducing dependence on the dollar, moving closer to BRICS, expanding trade with China, and diversifying away from U.S. treasuries. When they choose silver alongside gold as a monetary hedge, they're revealing what they expect the next decade's system to look like. This starts to resemble the 1980 Hunt brothers squeeze, except the Hunts this time are nation-states with unlimited capital and no reason to ever sell. In January 1980, the Hunt brothers tried to corner silver through futures and physical accumulation, driving prices from 6 to 50 per ounce in 4 months. That lasted until COMEX changed the rules, raised margins, and forced liquidation. The Hunts lost billions and silver crashed back to $10. But they were just individuals running on borrowed money and limited resources, so they could be crushed by rule changes and margin calls. Central banks don't work like that. They don't face margin calls, and they don't need to liquidate to meet redemptions. They accumulate patiently, and they can hold indefinitely. And they aren't doing it for profit, they're positioning for a shift in the monetary system itself. So when Switzerland, Singapore, and Saudi Arabia are all buying silver at the largest scale since the 1970s, you're not watching a normal commodity trade. And when the BIS, the central bank of central banks, effectively remonetizes silver as a Tier 1 asset, you're watching the early stages of a monetary transition. COMEX, with only 34.2 million ounces of registered inventory and a fractional reserve structure built for a world where silver was just industrial, is not prepared for what happens next. That's especially true when sovereign nations start treating it like money again. Now here's the terrifying part. When you run the numbers, the ones nobody wants on the front page, the outcome narrows fast. At today's price of $72 per ounce, silver is still roughly 89% below its inflation-adjusted 1980 peak, once you account for monetary expansion. Either silver is one of the most undervalued assets on the board, or the 1980 price was a one-time bubble that tells us nothing about fair value. But the difference between then and now is everything. The Hunt squeeze was two people using leverage to build a position of roughly 200 million ounces. When margins were raised and liquidation was forced, they had to sell. The buying pressure vanished, and the price collapsed. Today's squeeze pressure isn't coming from leveraged speculators. It's coming from sovereign nations, central banks, and industrial users with structural long-term demand. China isn't getting margin called on a 739 million ounce position. Saudi Arabia isn't panic selling because an exchange tweaks the rules. And manufacturers don't get to opt out of silver demand. Tesla needs silver for EV production whether the price is 72 or 172. That's why changing margin requirements won't break this kind of squeeze. The buyers aren't using leverage, and many of them can't walk away. So if inflation-adjusted comparisons imply silver could reach anywhere from 183 to 681, and if today's supply-demand fundamentals are tighter than 1980, what's a realistic target? Here's a conservative framework that doesn't rely on extreme scenarios. Let's stay conservative. Assume industrial demand holds at 1.24 billion ounces. Assume investment demand doesn't rise beyond 340 million. Assume mine production doesn't fall further. Even then, you're still looking at an annual deficit of about 265 million ounces. With global inventories around 687 million ounces, that burn rate implies roughly 2.6 years before inventories are exhausted. But markets don't wait for zero. The moment traders see only about 2 years of cushion left at current prices, they bid first and ask questions later. So the real question is, what price destroys enough demand to balance the market? At $72 per ounce, solar margins get squeezed, but projects still move forward and companies are still locking in supply. That's not equilibrium. At $100, some projects get delayed, not canceled. Demand might dip a little, but nowhere near enough to erase a 265 million ounce gap. At 150, you start seeing real demand destruction. Solar slows materially, manufacturers delay non-critical uses, but you also ignite a new wave of investment demand as retail and sovereign capital rush in. That's why, under orderly conditions, the balancing price likely lands somewhere in the 150 to 250 range. But this won't be orderly because the futures market has a delivery problem. COMEX is staring at key dates that can trigger a chain reaction. January 15, 2026 is first notice day for the February contract, when holders can start demanding physical delivery. Right now, open interest is about 67,000 contracts, roughly 335 million ounces notional. If even 20% stand for delivery, that's about 67 million ounces demanded against only 34.22 million ounces of registered inventory. COMEX can't meet that with metal. They'll offer cash premiums, they'll push rollovers, they'll try to buy time, but some holders will refuse in demand bars. And once the exchange can't deliver, the default clauses don't just hurt February. They change behavior. February 28th is the delivery deadline. If COMEX fails on even part of February, March contract holders see the risk instantly, and they rush to stand for delivery before inventory disappears. That's where the cascade begins. Once that fear takes hold, everyone stands for delivery at the same time because nobody wants to be last in line when inventory runs out. March open interest sits around 43,000 contracts, representing about 215 million ounces. That's when the panic feeds on itself. April, May, and June holders either rush to demand delivery or scramble to roll into the nearest spot months. And then you hit another pressure point, March 31st, the Basel III net stable funding ratio deadline. That forces many European banks to shift from paper exposures into safer structures, often meaning more pressure toward physical holdings or higher capital penalties. From there, you get the cascading scenario: each month's failure triggers the next month's rush. The COMEX silver market, the pricing engine that has set global silver prices for half a century, can unravel in a 97-day window between January 15th and March 31st, 2026. And if that happens, price discovery shifts away from paper futures and into physical spot markets. But physical markets don't care about fair value. If global inventories are less than 30 days of supply, the price becomes whatever number forces demand to ration immediately, not over 2 years, not over 6 months immediately. That's when you can see $200, $300, even $500 per ounce. Not because silver magically became worth that intrinsically, but because that's the price level required to prevent the shelves from going empty once the main pricing mechanism breaks and panic takes over. The banks already understand this timeline. That's why JP Morgan paid roughly $71 to $80 per ounce for 12.4 million ounces on December 18th. That's why HSBC and Bank of America followed with their own urgent buying. They've run the same 97-day cascade and concluded they need metal before January 15th, so they're paying today's premium to avoid next quarter's disaster. And here's the part that makes it feel inevitable. Even if the exchange limps through February, using cash settlements and regulatory patchwork, the underlying deficit doesn't disappear. A 265 million ounce annual shortfall keeps draining inventories quarter after quarter. China's export ban doesn't just vanish. Central banks don't suddenly stop buying. Industrial demand doesn't collapse overnight. Intervention can only delay the adjustment, and the longer it's delayed, the more violent it becomes when it finally hits. You can't regulate away a physical shortage. You can't print silver. The metal either exists in deliverable form or it doesn't. And right now there simply isn't enough deliverable metal to meet demand at today's prices. You've got about 97 days before the first domino, January 15th, when the pressure turns into action. The banks already see what's coming. That's why they're buying at $72 now, after selling paper claims at $28 just 6 months ago. Sovereign wealth funds see it too. That's why Saudi Arabia, Singapore, and Switzerland are adding silver to reserves for the first time in half a century. Industrial users see it. That's why companies like Tesla and First Solar are locking in multi-year forward supply, even while publicly complaining about costs. Anyone who runs the numbers ends up in the same place. COMEX can't meet delivery obligations with the inventory it has. And if defaults begin, price discovery shifts from paper to physical into a market with less than 6 months of global supply available. The question isn't whether COMEX breaks. The math says it breaks unless demand somehow drops by 40% overnight or massive new supply appears out of nowhere. The real question is timing. Will you be positioned before the crowd connects the dots or after? Because once the mainstream financial media starts reporting delivery failures and banks defaulting on futures obligations, the window to buy physical at anything close to today's prices will already be gone.